Ladies and gentlemen, good evening. This is Christopher Aaron. Welcome. I want to have a serious discussion with you tonight. We are going to talk about United States bonds and how bonds relate to the gold market. We are talking about the absolute definition of paper versus physical. So this is extremely important for you. Whether you are a gold investor and you want to watch the relationship between these markets, or whether you are a trader and you're willing to trade gold or bonds, either way, this relationship is going to impact you. You will see why in just a moment. Let's dive right in. Now, before we pull up the long-term bond chart itself, I want to pull up this ratio chart. We are looking at the relationship here between gold and 30-year United States bonds from 1978 through the present. We are looking at all the available data that we have as human beings and studying that to the best of our ability together. And by the way, I do read your comments. I thank you for writing. If you want to write a comment, I can't respond to nearly every single one, but I try to read most of them. And I love individuals who either agree or if you disagree, absolutely fine. If you have a valid comment or a point, hey, if I'm proven wrong, I'm proven wrong. But go ahead and post the comment. We're looking at gold versus U.S. 30-year bonds, 1978 through the present. Now, there are two data points here that I want to draw your attention to. We are talking about the peak in the value of gold versus bonds that was hit in the year 1980. You can see that here on the ratio. We're talking this 14 level on the ratio. And notice this corresponded with the peak in gold at $850 an ounce in the year 1980. Now, what happened after this peak is that gold declined in value for 21 years. So, 2-decade bear market in gold after it peaked versus bonds. And may I draw your attention to one thing, please, which is that gold in the year 2011 hit the same relative value versus bonds that it hit in 1980. This was a bubble valuation. We can say that for sure. Silver hit $50 an ounce. Gold hit $850, and they both declined for 20 years. Okay, so the market had overpriced them for a period of time, and then they declined for 20 years. Now, the price of gold got back to the same level that it was in 1980 versus long-term U.S. bonds. In 2011. Does this mean gold hit another bubble in 2011? What do you think? Now, fundamentally, I do not think that gold was a bubble in 1980. Well, yes, I don't think it was a bubble in 1980, nor do I think it was in 2011. We're talking about something that goes way beyond the financial system at this point. Something that is the sole currency that stands the test of time when all the fiat governments are debasing their currencies continuously. But my opinion is rather irrelevant to this discussion. We're talking about what does the market think here? The market in the year 2011 priced gold at the same valuation as a former long-term peak, which was taking on some characteristics. Let's admit, we have heard stories from 1980 about individuals who were lining up around shops. They were lining up to buy gold coins and bars around the block. You know, individuals were checking the price of gold daily and weekly to try to buy at the best price. You know, investors were saying gold was going to go to 1,000 and 2,000. Look at this advance here. So this was taking on some characteristics of a mania, and gold hit that same level in 2011. You're telling me there's not significance here? Now, if you're following the metals now, you will want to pay attention to what has developed here. There was a downtrend break. You can see that in 2016, and something of a expanding channel here that is developing. And the question is this channel going to be a similar scenario to what developed here in 1986, 87, where gold rose versus bonds, but this proved to be a counter trend, right? Counter trend move to the next 13 years of falling gold prices. Is this going to be the same thing? I'm playing devil's advocate here for a moment. We have to consider the negative side if we are going to be prudent investors. Now, let us pull up the 30-year bond chart. 1 week ago, we looked at the Federal Reserve controlled interest rates. We looked at those short-term interest rates, how those compare to the price of gold. We're no longer looking at short-term rates. We are looking at long-term rates. We are looking at the rate for the U.S. 30-year bond. This is the longest bond that is issued by the United States government. When you buy a U.S. bond, you're loaning money to the government, and you're saying, government, I trust you. I trust that you're going to give me back this money, first of all. Second of all, that you're going to give it back to me with a level of interest that compensates me for the risk and for the inflation, which is inherent in the system. So if you buy a U.S. 30-year bond, you are saying those things. You admit those things. So keep in mind when we're looking at the chart of a bond here, a 30-year bond from 1980 through the present, we're extending it out a little bit so we can project this into the future in a moment. You are saying all those things. Now, the point that I want to draw your attention to here, we are looking at the bond price. Okay? So keep in mind, the bond price is inverse from the interest rate. When bonds move higher, the interest rate is moving lower. This is how bonds work. It's a seesaw between the price and the interest rate. So when we're talking about bonds that are at or near all-time highs, we're talking about interest rates that are at or near all-time lows. Please keep that in mind throughout the remainder of this discussion. So where are we here with the U.S. bonds? One thing should be absolutely obvious at this point. We are talking about from 1980 through the present. And by the way, this is a form of analysis that goes out to premium subscribers in iGold Advisor. But I will tell you, we look at that from the standpoint of precious metals investors. So if you want to be the most informed and the best educated precious metals investor, consider iGold Advisor. The link is below. If you want to trade bonds with us, which I think is setting up over the year ahead, a major short opportunity. Think about what I'm saying for a minute. Shorting bonds. I'm telling you that paper bonds are going to be losing an immense amount of value throughout the rest of our lives, but I think the opportunity is setting up 1 year from now. Okay? So if you're a precious metals investor who you're saying, I'm only into physical, I'm saying the same thing as you. I'm just talking about the fact that this is going to be playing out in the bond market separately, the paper market separately. Okay? These things manifest in various markets simultaneously. So let's look at this for a minute. Now, iGlobal Analytics, which is coming out, you'll see the link for that below. It's coming out within the next several weeks. We're close. We are close. A lot of things had to go into this, but we are close. We are going to be shorting the bond market. We are going to be betting against United States government debt. And when you see what is setting up here, I think this is going to be the opportunity of a lifetime. That's the best way I can say it. If you are a speculator and if you want to make money off of the decline in U.S. bonds, which I think is setting up. Let's take a look. We had the rising channel, 38 years. How many investors remember when bonds were falling in price? If you can remember that, you must have been an active investor through the 1970s. And I'm asking you to raise your hand right now. I'm asking you to say hello, say hi, leave a comment, and please let me know, what do you remember from a period of falling bond prices? Okay, because that's going back before my memory. I'll just say that right now. I know I date myself a little bit. But if almost 4 decades of investors know only that bond prices rise year after year, then we are setting up here for something that could be equally powerful in the opposite direction. This is my thesis. Take it or leave it. This is what I believe is setting up. Let's look at this. Notice the 38-year rising channel, parabolic attempt. This made an attempt to break out in a parabolic kind of way, and it failed. So when you have that, when you have an attempt at a breakout from a multi-decade channel like this that fails, this is telling you something. It's telling you this market took on characteristics of a mania. We're talking about similar characteristics as condominiums in Miami and Las Vegas in 2006. We're talking about the same kind of characteristics as the tulip mania in the Netherlands, in Holland, in the 1600s. This market, after 4 decades, began a parabolic advance and it failed. Now we're still within the rising channel. Let's zoom this in for a minute. Now I'm going to get highly technical here for 1 minute. Highly technical. So if you love to study the charts and the formations that are setting up, please watch this. If you don't, wait for 2 minutes and you'll see the conclusion to this. But we're zooming in. We're looking at the end of that 38-year channel. This is a 10-year chart that we're looking at now. There's the parabolic blow-off. Look at the failed breakout. Notice where we are now. We're back within the lower part of the channel. Notice that hit on the lower part of the channel. Now, a head and shoulders formation set up from 2014 through the beginning of 2018. Left shoulder, notice here, this rise above the 147 mark. The head all the way up to 177. And the right shoulder, once again, above this 147 mark, right here in the middle, shown by black. Left shoulder, head, right shoulder. This broke down decisively, and the market bounced at the lower channel here. Now we're getting a test on the neckline of this formation. If you're a technical trader, you know what I'm talking about here. So look at this setup. What's happening here is we have buyers on this lower end of the 38-year channel that are conflicting with sellers from the head and shoulders setup. So what I think is going to set up now, I actually think, by the way, this is the target all the way down here for the head and shoulders pattern. The target is all the way down here at 117, 118. This is a majorly lower target for United States government debt. And we're talking about the funding mechanism for all the unsustained liabilities, Social Security, all the war programs, including the drone program, which cannot be paid off, which I participated in. We're talking about all these unsustainable programs, the bank bailouts. This is the target, the immediate target for U.S. government debt. It is lower than we are today. However, we can see that buyers have stepped in here at the lower trend line, and in my opinion, they are actually going to try to negate the neckline of this head and shoulders pattern. They're going to buy the U.S. bond back up into this region, corresponding with the right shoulder, corresponding with the 50% Fibonacci retracement of the entire decline from the absolute high in 2016 to the low in 2018, shown by this red shaded circle right here. This is what is coming. Let's zoom it back out. So I think what is setting up here is something like this. Can we imagine there's been a 38-year rising channel in the U.S. bond, that this could actually negate the head and shoulders top here that we're looking at, have one final exacerbating sort of high here, and then fail. And this is going to be setting up to be the short of a lifetime. Not only that, it won't only be a one-time opportunity. Can we imagine, all the times where bonds were a good buy? If you bought bonds here in 1982, 84, 87, 1990, 1994, if you bought bonds again here in 2000 or in 2002 or 2004 or 2006 or 2008 or 2010 or 2011 or 2013, bonds were a good buy the entire time. Excellent trading opportunities as well. What I think is setting up here is something like this in reverse. Okay? Something like a 38-year or 40-year, maybe by the time this whole thing is done, a 40-year declining linear channel, which is going to provide opportunities to short bonds, not to buy bonds, but to short U.S. government debt every 1 to 3 or 5 years on the upper channel boundary like this for the rest of our lifetimes. So if you're a trader, I would say welcome to the future of your trading career. Your trading career is going to have opportunities for the next 3 to 4 decades, which involve shorting U.S. government debt due to all those unfunded liabilities and unpayable war debts. All of that is going to come home to roost, and it is going to be a phenomenal opportunity to be trading short U.S. government debt. Stay tuned. Once again, to bring up that long-term chart, if you're a precious metals investor, just remember this. So we had those two peaks in the value of gold versus bonds. And if you're telling me this wasn't another bubble in 2011, we have an established bubble in 1980. If this wasn't one, well, this ratio better come and better keep rounding upward. That's all I can say. Watch the lower boundary of this blue trend channel here for an initial breakdown point. We would want to watch the 8.5 region on this channel. This will be going out to premium subscribers when we observe it. Okay, guys, so this is going to get super interesting over the years ahead. I really think that whether you're a stacker only interested in the physical metals, or whether you're interested in being more of a trader and really investigating all these different markets together, I think there's going to be opportunities for everyone. I would just ask you to really look logically. Look at those hits on that long-term chart in the ratio between gold and bonds and tell me, in your opinion, how is it that that was not a long-term top put into the precious metals? I'm playing devil's advocate here. That's all I'm doing. I'm presenting data to you. And if you disagree with it, let me know. So happy to have confirming comments. I'm happy to have disagreeing comments. The only comments that really are not appropriate on this channel are derogatory comments. So I have a assistant of mine who just tries to weed those out. But any sort of logical discussion, rational-based discussion on anything in this video, whether you agree or whether you disagree, let me know. If you're a physical precious metals investor and you want to follow things like this is what we do in the premium service. We send flash updates right to your inbox. This is published once a week. We look at the charts of gold and silver and the mining complex and all of the companies that we are investing in here. We do that every week. We do a video like this, which is longer and more in depth, once a month. If you want to be an informed precious metals investor, that is the service for you. If you want to be a bond trader with us, this is coming soon. This is coming soon. I know I've said that for a number of weeks, but it is actually truly coming soon. It's just a matter of a little more time to get all the technology down. But we are going to be, so when I say these things, looking at stocks, bonds, and currencies, I don't just mean we're going to be going long. We're going to be shorting bonds in this service. I'll tell you something, we're going to be going long. It's going to be platinum. So a great opportunity to be buying platinum and shorting U.S. bonds, I think, is setting up over the next year. There is a link below this to a free sign-up if you want to be notified when the service is available. This is going to be a premier service. It's not going to be cheap. It's going to be for traders who really have an interest in making profits on all these markets together. I thank you for tuning in. When we look at that bond versus U.S. Price of gold chart, you tell me, once again, what do you think? Was 2011 the same sort of top as 1980 or not? But please give your reasoning for that. Thank you, and I'll see you this time next week.